Portfolio Builder members, sorry about the delay in today's trade alert. Good news is the market has traveled higher on our positions we're closing out today. So you'll actually have a larger profit than I did and a slightly different P&L going into the next trade alert. Now it's still good, so you can still follow the same strikes. If you do want to be a little more advanced, when there is a difference, you could simply push it up by 50 cents because we had 50 cents appreciate since I issued the trade alert. So if you want the exact same risk to reward ratio as I had, push up both your strike and your call 50 cents. Otherwise, don't worry about it. You'll have very similar results. You'll make a little less on the next trade if we win, and you're going to book a bigger profit today because the TLT did travel about 50 cents in our favor since I took the screenshot. Let's go ahead and take a look at today's trade alert update. Trump signs the Hong Kong bill. Outraged China takes no action yet, just a whole lot of barking. So we'll see how this all plays out. Now, like I said, the TLT did climb a little bit higher to 140.6, which is about 40 cents higher than when I took the screenshots in my portfolio. So we're up a bit more. And also GDX is climbing. So we're up a little bit more on the GDX position. I'll go down to the current trade alert to review your actions today. In this case, your put option on the TLT has only a 1 cent value. You can allow it to expire worthless. We just need to buy to close the 142 call, and then we can sell to open the 142 call expiring December 6th, and buy to open the 138.50 put. So in our trade setup, we have a maximum profit of 170 and a maximum risk of 180. So if you want to push up your strikes 50 cents, go for it. If you'd prefer to just keep the exact same strikes as me, that's perfectly fine. It's only going to change your outcome by a few, around 10 to 20 cents. So it's not a big deal and totally up to you on that end. On GDX, we are buying to close the 28 call and selling to close the 27 put, and then rolling that into next week with a 28 call that we're selling and buying the 26.50 put. And so we're taking a maximum risk of $58 per contract on GDX with a potential profit of $92 per contract. Let's take a quick look at our program, and we'll switch over to the topical news over the last 48 hours. There's some interesting news that is bubbling up around the U.S.-China deal. Daily income trade alerts at noon Eastern. We trade the SPY ETF Monday, Wednesday, Friday. Now today we're trading GDX and TLT because we were off for Thanksgiving yesterday. And our Wednesday trade carries over to Monday. Emerging markets will be trading on Tuesday, which is starting to look very weak. We can't wait to bet down on emerging markets. Target income is $750 per month per $75,000 invested, or 1% per month. Our average return is 1.35% per month. We've had profits in 11 of 12 months. Largest drawdown in a single month is only 1%. We've never lost capital over a 90-day period. And you can see we perform exceptionally well when the S&P 500 tanks. Look at December. S&P 500 lost 16%. We pulled in 1% return. In May, it lost 7%. We pulled in 2.2% return. In August, we returned 0.8%. Since August, I've been playing it very safe. I'm expecting the trade war to escalate, and that could be devastating for people who are long equities. So we've been playing it very safe, very conservatively, inking out some tiny profits in September and October. I think we're on the verge of a catalyst that's going to make it clear whether the market's headed higher or lower based on trade deals. Phase 1 trade deal either getting escalated into a full-blown trade war or potentially having a truce where they might roll back some tariffs and agree to some agricultural purchases. Hey John, how's it going? So we have three setups. We have the up in the air trade war setting, which is where we're currently at, although we're on the verge of going into a trade war. This is where we're long the SPY, emerging markets, TLT, and relatively tight with our option caller on GDX. So this is where we're at right now. But we did inch another step closer towards escalation when Trump signed that Hong Kong bill Wednesday. Now we've seen the Chinese having a fit, but they haven't really taken any serious actions yet. Now, if the trade war escalates, we're not going to change the assets we're holding. We're just going to flip the option caller to be inverted. It's a very clever way to profit from a downside move because we can be the landowner, the property owner, owning the SPY in emerging markets. We can sell the in-the-money call option for a huge premium and then take that premium and buy an in-the-money put. And it actually gives you essentially a free way to bet down on an asset class. It's a beautiful, safe way to profit with very low risk using large amounts of capital on markets falling. And now these don't fall that often, but when they do, it's extra profitable for our portfolio. So if the trade war escalates, we'll be using the inverted option caller on the SPY and emerging markets, and then the loose option caller, which is bullish on the TLT and GDX. Now, if the trade war really gets a phase one deal, I would expect the TLT and GDX to sell off, not for very long. Big picture is those must go up. We'll take a look at that in our webinar coming up in about an hour and a half. But this is where we want to be very bullish on the SPY and emerging markets. So it'd be the exact opposite of an escalating trade war. So when we look at the option callers we can use to protect our positions in profit, if we have a loose option caller, expect the options to lose money and the underlying asset to deliver your profit. If we have a neutral, tight option caller, the options may generate the profit, and we do well if the market just goes flat or up. We don't actually need the asset to go anywhere, and we're collecting a lot of premium from selling that at-the-money call option. And if we do a bearish inverted option caller, your underlying asset will lose value, but less than you're generating from the options. So a lot of people commonly mistaken that the options will always generate a profit. That's not the case. In fact, the only time we can expect our options to generate a profit is if we are in a flat market and have a tight option caller, or if we've used the inverted option caller and we've bet down. So that's the three setups that we use in order to follow this strategy that allows us to play the trade war in three main strategies. Up in the air, we want to be essentially long everything but tight on gold. Escalating trade war, we're short on equities, long on bonds and gold. And a de-escalating trade war, again, will be long equities and then short bonds and gold. So it's that simple, but paying close attention to the news and predicting what will happen and being prepared for it helps us optimize our strategy. Our simple ETF portfolio is extremely diversified and all you'll need for your retirement. Income and safety, not growth or speculation. We will always play it safe. I'd much rather have a flat return over a month or two while we wait for a catalyst to happen that could make a big impact on the markets than try to be giddy and hopeful and catch something lucky. So you can simplify your holdings, reduce your risk, get better results with less work, and weatherproof your retirement portfolio. Also, we're going to go ahead and extend this sale that was going to end yesterday. We still have one spot left. If you want to save 40% annually and get 1 month free into our $10,000 boot camp, call Dean today, 505-322-7515. We don't go outrageous with Black Friday sales, but we are going to go ahead and extend this sale through today. So call Dean right now, 505-322-7515. Here's our disclaimer if you want to pause it and check that out. Let's take a look at the news. So here's what is likely to rattle the markets next week. We have a very well-timed move by Trump. Right after the market closed and we'd hit that 315 target on the SPY that I've been talking about for months, he came out and signed the Hong Kong bill, which China had been signaling if they did that, they may walk away from the trade deal altogether. And he says, I signed these bills out of respect for President Xi, China, and the people of Hong Kong. They're being enacted in the hope that leaders and representatives of China and Hong Kong will be able to amicably settle their differences, leading to long-term peace and prosperity for all. It's now day 510 of the trade war. We have both parties, both leaders of the respective Democratic and Republican parties signaling their support and appeasement that Trump did sign this. Grateful for POTUS signing our bipartisan legislation to stand up for the brave people of Hong Kong and hold Beijing accountable. The United States of America stands with Hong Kong. Several banks suggesting China's response will be to walk away from the trade talks. Very tough call on this. At the same time, China is having severe economic problems. Furious China warns the U.S. plot is doomed, threatens retaliation after Trump signs Hong Kong democracy bill. Nancy Pelosi, with the signing of the Hong Kong Human Rights and Democracy Act, the Congress has sent an unmistakable message to the world that the United States stands in solidarity with the people of Hong Kong and that we fully support their fight for their freedoms. Global Times, breaking, China Foreign Ministry voices strong opposition to the Hong Kong Human Rights Democracy Act. This seriously interferes with the internal affairs of China. Based what I know, out of respect for President Trump, the U.S. and its people, China is considering to put the drafters of the Hong Kong Human Rights and Democracy Act on the no-entry list, barring them from entering Chinese mainland, Hong Kong, and Macau. Beijing protested U.S. law in Hong Kong, but did little else. Instead, officials are betting Trump won't actually implement the law if he wants a trade deal with China. Here's a look at Hong Kong's balances. So they, by law, have to exchange an unlimited amount of Hong Kong dollars for the U.S. dollars, and it's pegged to the dollar. The big expectation from Kyle Bass, who's all about this, is that they will change the peg from being linked to the U.S. dollar and relink it to China's renminbi, which could considerably devalue each Hong Kong dollar. And on top of that, I'm expecting the Chinese currency to devalue probably by at least 50% in the next several years. So if you're in our boot camp, we're getting ready to put the first trade to begin shorting the Chinese currency. Not this Tuesday, but the following Tuesday, we're going to take a deep look into Hong Kong's balance sheet. They have the same problem as China. Essentially, they've printed a ton of Hong Kong dollars, but they have not grown their foreign reserves to be able to fund all those Hong Kong dollars. So as more and more capital outflows of Hong Kong and converts into the dollar, they're running out of capital quickly. So they've already burnt through some 80% of their foreign reserves, and now it's questionable how they're going to continue funding that, especially as they're seeing a recession and all this chaos in Hong Kong. A huge bet right before, there's been a lot of interesting bets on the market, very speculative, risky bets placed right before key news events hit. And so a lot of people are thinking that maybe insiders in Trump's cabinet are taking advantage of this. But the big bet that came out was a 2021 long call option on gold in the futures market at the 4,000 strike. So that is a tripling of the spot gold price in the next year. So they're expecting massive quantitative easing, all the central banks to drop to zero, and potentially even a stock crash. And so we've seen some very odd bets. Another interesting bet was a gigantic bet on the 35 call VIX option, which is also a trade we've done in our boot camp. So I do intend to build on that position, but I did want to wait another week to build on it. Our long SPY call perhaps will be closed out next week unless we see some sort of dramatic improvements in the trade war talks. Okay, China's economic growth could slow to 5.7 in 2020. I think it's going to crash much faster and much lower than that. So we'll see. The two countries are moving closer to a phase 1 deal, but unlikely to strike more ambitious phase 2 or phase 3 deals. The Chinese market has been crashing and just broke below that 288 level. A lot of problems in China. Last week we were showing some pictures of people doing bank runs, huge lines at ATM machines. No one wants the local currency. They've printed, this is crazy, 210 trillion won. That's the unit of the renminbi. And at this point in time, they claim each set of 7 won is worth $1. But this is all based on this real estate market they've built where there's no price discovery. You're not even allowed to sell property for a loss. So it continues to grow this GDP, and you end up with 25 cities that are almost the size of New York that are completely inhabited. We have 55 million condos that weren't even finished, just the stucco, just the concrete shell being built that were never sold, just rotting away. Meanwhile, you got 30 million Chinese living in caves with no irrigation. And there's banners all over these places talking about how great President Xi is, and they're going to build the Belt and Road Initiative. So bottom line is China is going to need to spend their renminbi, the yuan, but I don't think anybody believes they're worth $1 for 7. Maybe 14 yuan for $1, maybe 21 yuan for $1, but sure as hell not worth 7. So the big picture is they're going to have to slow down their debt growth, they're going to have to devalue their currency, and they're going to desperately need to attract outside capital because they're about to have a whole lot of hurt in China. And I think this is actually what they want. So they want to slow down their economy, get these debts out, and open up their economy and try to create better use of their resources that actually creates economic prosperity instead of ghost cities, which were just a huge loss. And so they really rely on the trade imbalance with the U.S. to have a surplus of dollars, which they can turn around and use to import commodities. So if the U.S. continues to apply these pressures and remove the dollars flowing into China, they're going to have an awful hard time having dollars to buy things to build all these projects that they're now focusing on, which is the Belt and Road Initiative, which I think hits 250 countries. So China's out signing these huge loans to all these little countries to go build these projects. And for these countries to pay their loans, they're having to devalue their currency. So if you did take the boot camp module last Tuesday, we looked at every foreign currency that's highly traded. And you can see over the last 5 years, most currencies have lost anywhere from 50 to 95% of their value against the dollar. So the whole world is hurting for some dollars, and this situation is going to continue on track. China is looking pretty weak here. You don't gain leverage in a negotiation with empty threats and appeasements unless they're prepared to exert some pressure. They'll get nowhere and look to be on the losing end. Now, we do know that Chinese have been trying to get their currency out of China through Hong Kong and through all their major banks and buy up as many assets as they can. A lot of real estate in Canada, New York, Australia, Hong Kong, but they also have their hands on stocks from all around the world. So I do believe China could cause a rapid sell-off in equities whenever they wanted to just by hitting the sell button. But they might be using that ammunition a little later if we don't come to a trade deal. Right now, there are multiple signs of strain in China's financial system. Runs on rural banks, unprecedented state-operated enterprises, debt restructuring, and rising consumer leverage. Also, an interesting chart is over the last decade, the average Chinese male went from owning one house to 3 houses in order to keep this bubble growing. And they don't even rent the houses out to anyone. They just let them sit there and crumble. 55 million of these houses not sold, just sitting there rotting away. Bank of China sent urgent message Wednesday to local government urging immediate issuance of all debts formerly earmarked for infrastructure projects. So they really need something to put all their people to work for that actually generates profits. And building more empty cities and houses is not the answer. So I think they're trying to get this Belt and Road initiative off to really save their economy. If they go down, it's certainly going to take the rest of the world down with it. It's just a matter of time. The bull run in China's housing market is coming to an end, and key cities are likely to see a soft landing in 2020. A soft landing maybe if the U.S. creates a trade deal with China that involves massive capital injections into China. But on the other hand, if we do the opposite and begin putting sanctions on China, getting all of our allies to bully China, then I suspect we're going to have something more like the period leading into World War II, where all of Europe was so greedy about trying to get reparations from Germany because of all the chaos they'd created during World War I, and losses and millions of lives lost. And what ended up happening is Germany's economy crashed. They couldn't pay the debts. They let their printing press go wild to try to pay these debts, caused their currency to devalue. They made some pretty crazy little tricks to create new currencies and ditch their old currency. And at the end of the day, it caused a worldwide depression. And then you get, so that's kind of what could happen if we do pressure China and punish China too much. So we'll be keeping close eye on that. China is always threatening to retaliate, but what can it do? Stop selling United States products? It must sell to try to maintain its ever-weakening economy. I don't think China is going to do much of anything. I think they're playing the whole Muhammad Ali, Frazier strategy. Just take the punches, try to get through this with as little change as possible, and make the rest of the world pay for the pain they are going to be suffering, because if China slows down, well, they've been the growth engine for the whole world for the last 2 decades, and especially the last 10 years. And so this is why we have all the central banks lowering rates, printing money. They see this from a mile away. They're not telling you that, but it's clear as day. U.S. is known for racial discrimination, police brutality, and mistreatment of prisoners. It broke world record. I suggest U.S. look hard in itself through the mirror. But I suggest you'd better not do it, in particular not to do it before going to bed. It will cause you a nightmare. This is the Jian Zhao. If one takes a glimpse into the human rights situation in U.S., it will not be difficult to find that the U.S. government, a self-styled human rights defender, has a human rights record which is flawed and lackluster, and the double standards of human rights it pursues are obvious. So he just went on a rant all morning about how we are hypocritical. Internet surveillance in the U.S. has become a common practice. PRISM is operating around the clock, vacuuming up emails, Facebook messages, Google chats, Skype calls, and the like. Money politics prevail. Total cost of the 2018 midterm elections was $5.2 billion, 35% increase over 2014. U.S. government is representing the super rich. U.S. has the highest rate of income and inequality among Western countries. The U.S. is enthusiastic about interfering in Hong Kong affairs. A big reason is because a chaotic Hong Kong is helpful in disrupting Chinese mainland. Am I right? But let me tell you, what's happening in Hong Kong has greatly united mainland society. That might be true right now, but not when their average income goes from, the $11,000 a year they're making right now down to $10,000, $9,000, $8,000, $7,000, $7,000 a year, especially when you get taxed at a 70% tax rate. So they have rising cost of food, a cratering housing market, and the potential to lose their biggest customer, the United States. So this is getting very hairy very quickly. Let's take a look at the charts. So we did hit that 315 SPY I'd been predicting on hopes of a trade deal. It's looking less and less likely that we will get a trade deal, but your guess is as good as mine. TLT is probably the main cause for our slow returns in the last 3 months. We've done fine. We've generated profits in all of the last 4 months. We have not hit our 1% target, but we had this surprise phase 1 deal that made a massive sell-off in the TLT that we were slightly unprepared for. But now it's reset. We know the TLT must go much higher, otherwise U.S. government is not funded. It's just that simple. So we remain long on the TLT and have a good profit on that today. This actually shot up an extra 40 cents when from the time we did the trade alert. Emerging markets has slowed down, as we've noticed for the several weeks, and lost track of the gains of the SPY. So this is not normal. Usually stocks are somewhat correlated. Last time we saw a major breakdown was in 2017, which did take about a year and 3 months for the SPY to catch up with emerging markets. So it's typical for smaller markets to start cracking first and then slowly work your way up the food chain. So right now, which markets are we seeing crack? Well, the CCC U.S. bonds are cracking. Those rates have spiked, so that's an alarm. Repo madness is at all-time highs. That's most likely from emerging markets who have U.S. denominated debts and their currencies have been devaluing. So you could go pull up any chart of almost any country and they are suffering. They have in total some $11 trillion in U.S. denominated debt, but their currencies over the last 5 years have lost anywhere from 50% of their value to 95% of their value. It's pretty much game over. When you owe a lot of money in the dollar and your country's currency has lost 90% of its value, that makes the relative interest payments 10 times higher than they were. So you can see why there's so much suffering in a lot of these countries right now. GDX has much further to go up. If we look at the last time we did massive QE was at the end of 2009. It took its time to work its way in the system, but eventually you got GDX up to 66. And this was from a small U.S. housing bubble that was about 2% of our GDP, which was probably about $20 trillion, maybe more like $18 trillion a decade ago. Now we have a housing bubble in China that's quite likely around, so you do the math, what is that? That's like a $400 billion potential loss that was sitting in the housing market from loaning money to people that shouldn't have had housing loans. Well, now let's look at what we have. We have a $13 trillion GDP in China, and at least 25% of their value is from their housing industry, which is at least in the U.S. we still had the ability to buy and sell your house at a loss, even though we had these we had this housing bubble where banks lent out money to unqualified borrowers. In China, it's much worse. You can't sell for a loss. We've got people starting up loans for 2, 3, 4, or 5 houses, and it represents at least 25%. So now we're looking at something like a $3 trillion loss sitting at a minimum in the Chinese housing market. So as that all unfolds, we're going to see massive QE, and I suspect GDX will blow past that 66 level. So we've been patient. We've had a little bit of a drawdown in the last 3 months on precious metals, but the risk to reward is tremendous. So we want to be long the gold miners at this point. Now, that spot gold bet is bizarre. Probably some sort of hedge for a gigantic central bank that has a huge equity position. But I'd much rather play the gold miners, especially with GDX, than spot gold, as we have all these central banks printing money at rapid pace and loading up on spot gold. I think we'll see the bigger return in GDX. Now, GDX, much smaller asset class, so you can't put as much money into it. So it's perfect for our audience. LQD is your high grade, your investment grade bond fund. This means Microsoft and Apple, companies like that, have extremely cheap credit to buy their own stocks back. I'm not willing to bet down on stocks for more than probably a 2 to 3 month period until this chart crashes. S&P 500 is dominated by these type of companies, and as long as they got access to free capital, it's going to be hard to get much of a sell-off. Now, sure, can we see a 1 month, 2 month, 3 month sell-off? Yes, but until we see a major crack in the credit market, which is how they're funding these stock buybacks, I'll be skeptical to bet on a big long-term downtrend in stocks. And if we escalate the trade war, this chart will travel much higher because the federal funds rate is going to go lower. So we're not seeing any weakness whatsoever in this end of the credit market. Okay, also, here's your junk bond ETF. It's also relatively stronger than it was a year ago. It's not at its all-time highest rating, but it's still relatively accommodative for your Russell 2000 companies to get a loan and do stock buybacks. Now we did see a part of HYG is that triple C, bottom of the bucket credit, and that's the only piece of the credit market we've started to see crack, except for, of course, the repo madness, which is at all-time highs right now. And they told us that was going to be fixed in a couple days. Now it's clearly not fixed whatsoever and getting worse. Now, IWMs or Russell 2000, this is looking very strong, very impressive. It does seem like we have a return of that 2017 middle of the year market phenomenon where you see rest of the world's really tanking and money is flowing into everything, dollar, U.S. Treasury, and U.S. stock market, not because it's a great investment or a value buy, but rather because everything else is deteriorating so quickly. So there is a chance that we could be betting up on the SPY and down on emerging markets at some point. But that'll be a tough call to make as they're typically quite correlated. We're seeing that correlation break right now, which is a huge signal to be long bonds and gold at this juncture in time, and to have very expensive put options protecting your equities. So I've been taking smaller gains on the equities, realizing there's massive downside risk. Let's see how the dollar's trading against the other major currency pairs. Now remember, China desperately wants to become a reserve currency. They have 210 trillion yuan, which is the unit of the renminbi, if that's confusing to anyone, and they are valuing it at 7 yuan per dollar. There's no way on God's green earth 7 yuan is worth $1. And as this continues to play out, and as they get more and more desperate for capital, they're going to have to open that exchange rate and let it find a fair value. And I think they'll try to slow this process down as much as they can. But probably a fair value is going to be much, much less. And it just depends on how overvalued they've marked their companies, their real estate, all kinds of things, which are all top secret, hidden under the Communist Basic Law, which states that you can't look at their accounting but because it's part of their state secrets. So euro continues to weaken against the dollar. The yen continues to weaken against the dollar. And China's currency is starting to edge up a little bit higher. If we get close to that 7.2 again, I may rush us into the boot camp trade in one of 4 legs. I am planning to spread it out over one of 4 legs, so keep an eye on that. But I just want to see what on earth is going to happen with this trade deal. As soon as we do get a yes or a no, it'll be a much easier opportunity to jump into that trade. Here's a better look at CNH. Now keep in mind, over the last several decades, this was at 2 and has already devalued to as high as 9, came back down to 6 ever since 2010 when their GDP crashed below 10%, and it's never gotten back to that level. In fact, even going below 8 was supposed to be the end of the world. Well, now it's at 6 and falling quickly. So ever since 2010, they've lost control of that conversion rate, and it's slowly weakened from 6 to 7. I suspect this will, with natural forces, gradually travel higher and higher. German Bund, you can see the clear downward gravity pulling this lower and lower. My expectation is this will go back to negative territory and drag the TLT with it. And again, if the 30-year Treasury goes below 2, that would be very profitable for the TLT because it would travel higher. So lower rates, higher TLT. And so that's where we're at right now. The dollar, how strong could it get? Well, we've had several time periods where it went to 120 level, and that's because we get the whole world in this trap where they go borrow money in dollar denominations, and then by having a stronger economic powerhouse in the United States, better economic policy, we're able to make everyone have to exchange their currency into dollars all the time just to pay their debts. And so I do suspect this will break 100 if the trade war escalates, which would most likely cause new tariffs, which would cause China to forcibly allow their currency to devalue more, which puts more pressure on all their trading partners to devalue. So that's what I expect will happen as soon as the trade war breaks down and tariffs go up. Meanwhile, China caused a little bit of panic in Bitcoin and Ethereum, cracking down on capital outflows. But I told everyone, buy the dip. This is the best time in history possible to own these assets, gold, Bitcoin, and Ethereum. We're headed towards a major catastrophe in the financial system. And it's just because of this massive, massive debt bubble that's everywhere, from sovereign debt to corporate debt to consumer debt. It's endless. And the more debt we have, the more interest we have to pay, the more money the central banks need to print and keep lowering rates, and the more people are going to try to get out of their local currency into gold or something even more secretive like Bitcoin. So this is always a maximum position in our portfolio of 2%. We got into Ethereum at 90 and Bitcoin at 3,500, so we're up considerably on that. When the value of that's above 2%, we're taking profits off the table, and if it's below, we're adding. Now, when would we get out of gold and Bitcoin and Ethereum? Sometime after we get the hint that the central banks are going to start jacking up interest rates. So right now, that's not in the books. If they did that, it would crash all the bond markets and no governments would be able to fund themselves. So instead, all they're doing is talking about what they're going to do when they take rates to zero, and then again, what they're going to do once they get to zero, which is now talking about capping the maximum yield on bonds and buying an unlimited amount of bonds into the balance sheet. So that's certainly a reason to be long gold. All right, guys, that's our presentation for today. We are extending this deal through today. Call Dean, 505-322-7515. You'll get 40% off our annual membership, plus 1 free month in our $10,000 boot camp. We have some exciting trades coming up for boot camp members where we're going to short the Chinese currency and the Hong Kong dollar. So don't miss out on that, and I hope you guys have a great weekend and some happy shopping on Black Friday and Cyber Monday.